Welcome back to the Opportunistic Trader, everybody. It's about 10 o'clock on September 11th, and we're joined by Tony Greer of TG Macro. He's been joining us often, talking about the equity markets, giving us some great color on what he's seeing, and it's great to have you, Tony. What's going on?
Hey, thanks very much, Mike. Well, there's a lot going on in the equity market as usual. To start off, I got stopped out of the Nike short, but quickly, and that's okay because losing money is part of trading. Being wrong is a part of trading. I stopped out yesterday, pretty much right after the open, sensing that Nike was not going to curl over by any means. Technically. So that's how I knew that I was wrong. I thought that there might have been sellers coming after it after that run, and I thought it might have put it into some technical jeopardy. Turns out that's not the case. I'm out of the trade, and like with most trades, I have virtually no emotion over it. So that Nike trade done, and I'm on to the next. We've got a couple of other good things going on, so I can't complain about that.
Well, I think you said, just like you said before you even move on, that's exactly it. Look, through the course of the year, we put on hundreds of trades, and you win some, you lose some. It's important, just move on, keep the same rationale and same methodology.
Yeah, I'm actually pretty comfortable running in terms of a percentage. I'm okay 50-50 because the ones that I'm right on 50-50, I usually get a chance to pounce, and play some leverage bets. And that's kind of in the position that you want to be. Like I said, in the blackjack table, when you get dealt, you get a chance to split your cards or a chance to double down. I mean, those are the opportunities that you're looking for, and that's what the game's all about. So.
Yeah, and so I know you've been all over the transports and the truckers, so tell me what's going on there because they continue to trade well.
Yeah, big breakout in transports yesterday. I look at IYT as a great barometer of the sector. That ETF IYT, there was like a 2 sigma breakout yesterday to a new closing high for the move. It was mostly led by the trucking space, which I have been bullish due to the tightness in the space. And then we just got a big lift yesterday because there's anticipation that trucking rates in the east are going to go way up due to Hurricane Florence touching down sometime this weekend, Friday or Saturday. So I think leading the pack still is Landstar. Werner had a big 9% rally yesterday, and it's sort of given a little bit back today. But CH Robinson is one that is clearly breaking out to me. The ticker is CHRW. There was a little double top there around the 98-100 area from earlier this year, and CH Robinson broke through after testing its 200-day moving average. And that chart is pure artwork to me. I would be adding to my CH Robinson position through here. And so I think that's one that I can see trading up to 110 in short order.
Yeah, I have that chart up for everybody to see, and I have it up as a weekly chart, so you can going back about a year and a half, and we were down at $65. It looks like about a year ago, maybe 13, 14 months ago. So that's been a big mover, especially for that sort of sector.
Yep, it is. They consolidated quite a bit this year, and so it's encouraging to see them get back on the horse, and that's why I think that they can have a really strong end of the year, the truckers. Because seeing as they're just breaking out now, they're breaking out on the back of 4.2% GDP. They have pricing power. There's tightness in the industry. It's just I like being long sectors that have pricing power.
Yeah, you've been mentioning that for weeks and weeks now, and especially in this market where we're seeing emerging markets struggle. Tech's been on a tear, but has paused over the last few weeks. But these sectors you're looking at here continue to trade very strong.
So far, so good. The tranny's got the rails are still cruising along and making new highs on a regular basis. So it looks like this transport sector can be one of the life-saving sectors for the S&P right now.
Is there any ETF for the rail sector?
Strictly the rails, not that I know of, but that doesn't mean that there isn't one. I kind of go individually with rails, trade them individually, or trade IYT for all my transport pleasure.
Yeah, I have IYT up as well, that chart right now, and that's a beautiful looking chart.
Yeah, it's looking good, and it's looking the opposite of the gold metals and miners.
That's exactly what I was about to say.
It's always encouraging when they are down 1.25%, making a new low on the screen, and you are short the metals and miners. All I see, nothing has changed from the time gold broke down from 1350 to 1200. There's a chorus of supporters in gold. They've got 1,000,001 reasons why you need to be long. You need to have it in the portfolio. And my argument has been, we've already all got the gold that we're going to own, and it's time for the metal to go down now that there are better yields in the world. So I'm just continuing, these gold stocks are just going to literally get left for dead now. And I'm literally looking to pounce again because I think GDX can work its way down towards 10.
So that's I was going to ask you two things with that is how do you play the gold? Is it just a future? Are you looking at the futures, or has the equities actually underperformed the actual commodity itself? Or
Well, there's been a sort of recent breakdown in the metals and mining stocks. So if you look at GDX, that is a tradable ETF.
yeah, I just pulled that up for everybody to see, and so
Yeah,
we're trading about 1730 or so.
right, 1730. And basically, what has gone on in GDX is that it put everybody to sleep for the entirety of 2017 and half of 2018, trading in this 20 bit of 25 range. And it's sort of, if you ask me, it's just resumed its path down. I think that now that we are below this 2016 low of which looks like about 18 and a half here, I think that this is going to, I think that that GDX settles back in the 15, below the $15 range. So when you look at the underlyings, you get confirmation of that. If you look at the membership of GDX, it is 10% Newmont Mining, 7% Barrick Gold, and then 7% Franco-Nevada, and 6% Newcrest. So if you dig into those, you'll see that Newmont still looks like it's got a ways to go down. Today may be a good day for a bottoming, as it's really just gapped lower. It might be a day that it reverses a little bit. But I see Newmont falling off of a cliff below 30, and I don't see it stopping until about 15 or 20. So I have no faith in these to hold in there whatsoever.
Well, I was going to say, so what, you've been bearish on these for a while. They've had very ugly price action. Newmont, was over $40, and here we are under $30. Where do they stand right now? Here we are in gold, below 1200, but can these stocks, if gold kind of stays around these levels, will these stocks continue to underperform, or does it need gold to continue lower for them to take the next leg down?
Probably, I would say that it does need gold to take a leg lower. There's so many fans of gold, and the gold stocks are so liquid and accessible that if, fans of gold have got deployable capital and they see the metal holding in, they'll probably lend a bid to some of the gold stocks, the underlying names that they like, or the ETF, and just buy it. And then they could try to get it going on the upside. But the way I see it, as long as yields in the U.S. are firm, gold is going to get the crap knocked out of it.
Yeah. Well, on that note, the next obvious question is, what's it going to take for you to change your mind? What would make you neutral or bullish metals?
If one of the central banks starts expanding their QE program instead of cutting it down, we just had August was just the smallest month of ECB purchases since they've started the program. They're winding QE down. The US is obviously winding down our QE program slowly, but surely, as our balance sheet shrinking. And so I think that all of that is really, really negative for gold. Gold was doing its best when we had a huge pile of negative yielding securities, and that pile of securities is shrinking now as yields rise. So I literally don't see what turns this train around in gold in the near future.
Yeah, no, that makes a lot of sense. And now that you're mentioning, gold and kind of QE and those more macro topics, I know you look at the macro world. So what catches your eye right now outside the world of equities that you find interesting?
I'm always, I never take my eye off crude oil, and I'm still semi amazed that it's hanging in there, given that the Saudis bailed out on the Aramco IPO. And it looks like in the last energy reports that they've sold a little bit more production into the market. So, I've got a really close eye on crude oil because that is close to giving up its uptrend below 65 and a half. I'd be concerned about crude oil. Copper is another one that's holding a huge level for me. 5,800 in LME copper is an exact 50% pullback of the move from, I guess it's 30, range. Hold on, I'll get it up in front of me here so I don't have to guess. From about 4,300 up to 7,500. So the 50% pullback is 5,800. Everybody's bearish as could be copper. The funds continue to add to their short positions in copper, and it's still holding this level. So if copper somehow holds this 5,800 level while the funds are pounding away short at it, I would imagine that we could see a pretty good short covering rally in response. But that, like I said, that doesn't matter until it matters. I don't have any copper trade on yet. I'm just kind of watching those levels right now.
Yeah, that one's been an interesting one, just with your metals theme as well, and possibly also a lot of Asian. Maybe also goes with the EM underperformance, affecting that metal specifically. Any thoughts on yields here as we approach the 3% level in 10-year again, but really haven't done a whole lot.
Well, yeah, it's it hasn't done a lot, which is a positive sign to me. The 10-year yields have consolidated between 280 and 290, I would say, for the better part of the year. Now we bounced off the 200-day moving average at 280, this week, and it's interesting to see that while we print a huge GDP number, we're still running 2.9% inflation as of the last number with new data due this week. If anything, there's another massive position in the market. Funds are massively short treasuries. The whole market has got a bullseye on that position because they think that there'll be a reversal in the treasury market. And that will come at, probably due to a pullback in the U.S. economy. And these people are sort of praying with an A that happens. And they're not praying with an E about what goes on in the markets. And if you read the tape, we have got a spectacularly strong U.S. economy right now as far as the data that the market pays attention to. We've got strong manufacturing data, we've got strong industrial data, we've got strong GDP, we've got rising inflation, and we've got yields constantly rising. So, I don't know what is going to take that short treasury position out unless there is a drastic and abrupt slowdown in the U.S. economy, and I'm just not seeing it happen. So Treasury market's another important spot to watch.
Yeah, absolutely. And also, the non-farm payroll number was not, it came in line, but a few of the key sectors, the inflation component was higher. And, it's been interesting to see the yields continuing to tick up. Not many other markets aren't really looking at it as much, but yields have continued to tick up yesterday and today. And here we are right now, the 10 years at 297.5. So, we'll keep a close eye on that and the dollar based on that, and see if equities move based on any of that information.
Yeah, that was that. What was that? That wage growth, the wage data that we had.
Average hourly earnings.
Average hourly earnings, exactly. So that put us to plus 2.9% growth on the year, which is better than everyone's expectations. And that's another matrix of the economy that looks like it's doing really well. And when you've got, NFIB small business optimism trading 108.8, it's literally leaping off the charts with consumer confidence. And that's another factor that does not turn around very quickly, even more importantly than the data. So, I think if you're looking for the U.S. economy to slow down and bonds to rally, that you're looking in the wrong direction.
Yeah, well, it's been, we basically before that, the 10-year was at 288 before Friday's number. Now we're up closer to 298. But the range for the year has been very small as of right now. So we'll see if there's some last 4 month, if there's a big move in the market for the last 4 months.
Yeah, well, the bond bears have certainly got all the ammo they want to sit on the market for a little while. So if they can get rates up above 3%, then maybe they find a new incremental buyer. But I think they'll find a lot of people taking advantage of 3% over 10 years in the U.S. because that sounds like a great trade to me against what's available in the market.
Yeah, and then looking at today, it's funny. Nasdaq was weaker overnight, and as of the open, and then we've had Fang buying. I see Facebook is now green, $2. We got down to 163, so really was getting down to some low levels. Now we're up at 166. Apple was trading down at 216.5. Now we're near 220. So it's been a pretty decent bounce here. Anything in the tech names? I know that you've been a big fan of Apple and Amazon, or more of a fan of Apple and Amazon and the Fangs, and not as much as the other names. Anything else?
Yeah, I still think, I kind of, I maintain that position in Apple. I mean, I just saw a staggering figure the other day that Apple iPhone sales account for more revenue than 492 of the S&P 500 companies. And that sort of jarred me into remaining bullish Apple. Um, and across the FANG, I remain bearish in Facebook. I mean, the stock can bounce all it wants today. Young people are leaving the platform in droves. I think they're tired of the Zuckerberg Act. They're tired of being a part of this platform that, seems like it's just, obviously keeping track of all their data. Some of them don't care, but the ones that do are moving off to another platform. And when I look at the formation in Facebook stock, technically speaking, that thing is done. So I'm expecting Facebook literally to have huge, huge pullbacks over the next, 6 to 18 months. I won't be satisfied until it trades down to 120.
Yeah, you've been mentioning that, and you started calling for that when it was about $20 higher. So you've been on that one as well. All
So
right.
far,
Yeah, so far moving in the right direction, especially playing it against other tech names like Apple and Amazon. It's funny. I saw a chart this weekend of Alibaba. That's been an amazing trade as well. Like when you take a look at like Amazon versus Alibaba, that's been. I don't know if you pay close attention to Baba, but that's been a big down move in bear market territory here.
I don't, but I do have an opinion. Like most traders, from 30,000 feet up, if I was in Baba, I would be running from Baba with Jack Ma retiring and now Baba breaking this 160, 200 range that it's been trading in for 18 months with momentum on a headline. And now the moving averages are curling down over it. And it looks like Baba is going to head back down to 110 to me. So, like I said, I don't know anything else about it other than the facts that I've stated there. But man, that stock looks absolutely horrible from any perspective. Horrible.
Yeah, I just pulled that one up. I was reading a few different things about that. It's interesting to keep an eye on it. It definitely has not been, there a few week, probably a few months ago, people were talking about moving it into the FANG world, putting a B in there somewhere, and the market's glad they didn't do that officially.
No, we don't need any China search engines in Fang Complex. That's for sure.
Yeah. All right. Hey, thanks a lot, Tony. Tony Greer, TG Macro, a lot of great information. Thanks for helping us out with some good market knowledge.
Anytime, Mike. Have a great
All
day,
right.
my man.
Talk to you later.
See ya.